This topic is about overview of the business cycle, from learning module, understanding business cycles. When you see full capacity, record high optimism, and surging prices all at once, the economy is at its peak. Terms like testing the limits and overheating are the best clues that the economy has reached the peak phase. Option C, the trough is the opposite. There, you would see high unemployment and the lowest level of output. Option A, early expansion is too soon. In that phase, inflation is still moderate, and there is still plenty of excess capacity in factories. In the expansion phase, you should see positive activity. During this time, consumers increase spending and companies increase production and employment. As a recovery turns into an expansion, businesses stop just using overtime and start actually hiring new people, causing the unemployment rate to fall. In the early stages of growth, inflation is usually moderate or stable. It only starts accelerating or surging later on when the economy hits its peak. A simultaneous rise in spending, such as retail, and future planning, such as permits or startups, is the hallmark of an expansion phase. Building permits are a major signal for future activity because you need a permit before you can start building. A trough is the absolute bottom where output is at its lowest. A contraction is when activity is falling, not rising. In late expansion, firms are at high capacity and need more skilled workers. There are simply not enough qualified people available. This creates shortages and pushes companies to compete harder for staff. This topic is about credit cycles. Credit cycles usually take more time to play out than traditional GDP-based business cycles. Loose credit can make an expansion bigger or a boom, while tight credit can make a recession deeper. Even though they aren't always perfectly synchronized, they are definitely not independent. They influence each other constantly. This topic is about economic indicators over the business cycle. Employment is a lagging indicator. Businesses wait to see a confirmed upturn before they start hiring robustly again. While total output keeps growing through the expansion, the rate of growth in productivity is highest right after the bottom, because that is when the workforce is at its absolute leanest. Late in an expansion, productivity growth usually slows down because the economy is testing its limits and companies are struggling to find qualified workers. Unemployment stays high at the very beginning of a recovery because companies use overtime with their current staff first rather than hiring new people. Lagging indicators are used to confirm what has already happened in the past. If the recovery were just beginning, these numbers would likely still be flat or even rising. If it were about to reverse, leading indicators like the stock market would be dropping. But these lagging labor numbers might still look good for a little while longer. The peak phase is defined by shortages in factors of production, especially labor. Unit labor costs are a lagging indicator. They start to rise significantly only after the expansion is well established and the labor market gets tight. Option A. Productivity actually helps margins. It is its decline or stagnation that causes problems. While inventory to sale ratios do rise near the peak, this is usually because sales begin to slow before production is cut, rather than being the primary cause of margin pressure during the expansion itself. Leading indicators are valued for predicting the future course of the economy. The difference between cycles and long-term trends. Composite indexes focus on the short-term fluctuations, such as business cycles, rather than the long-term sustainable economic growth. The key job of these indexes is to signal when the economy is moving from expansion to contraction, a peak, or from contraction to recovery, or a trough. They are looking at the current quarter, not next year. Nowcasting is specifically about overcoming publication delays of official statistics. The use of non-traditional data, such as satellites and shipping, is a hallmark of modern nowcasting. No single indicator is definitive. Analysts must synthesize or mix information from all three groups to get a reliable reading. Words like confirmation, present state, and validate when thinking about coincident indicators. Option A is incorrect. Leading indicators are not sufficient on their own. They can sometimes give false signals. Lagging indicators are for looking at the past, not for predicting the future. Yield curve inversion is a heavyweight predictor. It is specifically highlighted as a signal that the economy is expected to weaken. At the peak, you often see lagging indicators like inflation still rising, but the leading indicators will have already started to drop or turn negative. In scenario A, everything is still looking good, rising permits and falling unemployment. In scenario C, the stock market, a leading indicator, is still rising, which usually suggests the good times are expected to continue for a bit longer. Whenever a leading indicator, the outlook, and a coincident indicator, the reality, move in opposite directions, the signals are conflicting. Analysts must look at a mix of indicators because no single one is foolproof. When they disagree, the near-term path is uncertain. Option A is incorrect. You cannot have a consistent signal of expansion if industrial production the main measure of current activity, is actually falling. Option C is incorrect. For an imminent recession pattern, you would expect the leading indicators to be falling, such as building permits or consumer expectations dropping, which is not the case here. If personal income is already declining, the economy is no longer in an expansion phase. It has officially entered a downturn. A rising inventory to sales ratio is a classic warning light that the economy is starting to choke on goods that people are no longer buying. In options A and C, you see indicators that are rising, surging, or expanding, like retail sales, housing starts, and industrial production. These positive movements mean the economy is still in an expansion, a recovery phase, not a slowdown. Only leading indicators have the value of predicting the future course of the economy. Hours worked is a sensitive signal because it is easier and faster for a boss to change a weekly schedule than it is to go through the expensive process of hiring new staff. When a question asks for a prediction or future state, you are always looking for the leading indicator. Leading indicators turn before the economy. For example, the stock market often hits its lowest point 3 to 6 months before the actual economy bottoms out. Whenever you see the word leading, look for words like precede, before, or predicting. Coincident means same time. Option A describes coincident indicators which move at the same time as the economy. Lagging means after. Option B describes lagging indicators which change directions later to confirm what has already happened. Employment data lags partly because businesses are slow to hire and fire. It is expensive to find and train new workers, so they wait for a confirmed trend. Average duration is a delayed signal. If you see it finally starting to drop, it is a confirmation that the expansion has been happening for some time. If employers were rapidly creating and filling jobs, the duration of unemployment would likely decrease faster than lagging. That is a confidence signal. People don't borrow money when they are scared. They borrow when they've had a steady raise for a long time. Remember that aggregate real personal income happens now, coincident indicator, but consumer debt happens later as a result of that income, lagging indicator. Option B and C, both declines and contractions in spending or retail, are characteristic of the contraction phase, not the period when income is rising. Coincident indicators tell you what is happening right now. Lagging indicators are used to identify the past condition of the economy and confirm that the trend is firmly established. Because industrial production has already been rising for half a year, the economy is not just reaching a trough, the bottom. It has been growing for some time.